Imagine buying a multi-million-dollar hypercar with flawless aerodynamics and thousands of horsepower. But when you sit in the driver's seat, you find the fuel line is only the size of a coffee straw. No matter how hard you press the accelerator, the engine is starved. It idles, unable to run at a fraction of its capacity.
That is exactly what is happening in AI today. Everyone is completely obsessed with the raw processing power of the GPU, talking about teraflops, transistor counts, and advanced silicon nodes. But the actual physical bottleneck in the real world right now isn't the chip. It is the memory feeding it.
This is the memory wall. In this inference era, raw computing capacity is no longer the absolute governor of speed. The speed limit is determined by how fast you can fetch data from memory and hand it to the processor. If starved of data, those high-powered cores sit idle, burning electricity while doing nothing.
An idle processor is an incredibly expensive disaster. That is why high-bandwidth memory, or HBM, is now the most fiercely contested asset in the tech ecosystem. Today, we are cracking open this memory wall to explore why it has become a master bottleneck, who controls it, and how it is quietly reshaping the technology landscape.
One small thing up front. We genuinely love these companies as stories, but we're explaining them, not recommending them.
So treat all of this as food for your own thinking, not financial advice. Stay curious, stay a little skeptical, and make your own calls.
Welcome back to Follow the AI Money, an educational series where we trace the capital flows of the artificial intelligence revolution. I'm Theo.
And I'm Maya. As we discussed in episode 1, our goal is to look at the world through the bottleneck lens. The core idea is simple. Locate the scarce, hard-to-expand inputs that the entire industry is forced to buy. We want to know who owns these non-duplicable physical inputs.
Exactly. And first, our standard ground rules. This series is strictly educational. We do not provide investment advice, buy-sell recommendations, or price targets. We look at these dynamics through a neutral lens based on industry consensus, using public companies solely as examples. Neither of us hold any financial positions in the companies we discuss today.
With that said, let's talk about memory. If you want to see our bottleneck lens in action under real-world conditions, there is no better live example than high-bandwidth memory. It is scarce, highly complex, and completely sold out.
It is. To understand why, we must look at how these massive AI models operate under the hood. Welcome to the Token Factory.
When you type a prompt and watch words appear one by one, you are looking at a digital factory. Each word fragment is a token, and generating them is highly repetitive and memory-intensive.
Right. Every single time the AI model generates the next token, it must read the entire weight of the neural network from memory, combine it with the prompt, and calculate the next word. For a model with hundreds of billions of parameters, that processor retrieves hundreds of gigabytes of data for each individual token output.
So, total token throughput is roughly equal to HBM capacity multiplied by HBM bandwidth. Think of the GPU as a massive, high-speed airport terminal processing thousands of passengers every minute. But the passengers don't live at the airport. They are shuttled in from a nearby hotel.
In this analogy, the shuttle is your high-bandwidth memory. The shuttle's capacity, its cabin size, determines how many requests and memories, what engineers call the key-value cache or KV cache, you can hold. If the cabin is too small, you can only handle a few concurrent requests, and everyone else waits outside.
Meanwhile, the shuttle's door width represents the memory bandwidth. It is how fast you can load those passengers into the terminal. If you have a massive terminal, but the shuttle door is narrow, the terminal sits empty. Passengers arrive too slowly, wasting its processing capacity.
This is the memory wall. Conventional memory is located relatively far away on a motherboard, limiting transfer speeds. HBM solves this by stacking memory chips vertically, like skyscrapers, right next to the processor, connected by microscopic wires. This widens the doors. Because a starved GPU is a multi-million-dollar paperweight, customers will pay almost any price for HBM.
Historically, memory was the unglamorous, highly volatile, pure commodity corner of tech. When prices rose, makers built too many factories. When the market flooded, prices cratered, and companies lost billions. But HBM has completely shattered that pattern, turning memory economics upside down.
The numbers are absolutely eye-watering, illustrating why HBM is a special bottleneck. TrendForce reports that in 2026, HBM is projected to account for over 40% of the entire global DRAM industry's revenue.
Over 40% of DRAM revenue is a stunning figure. But here's the kicker. HBM generates that while consuming only about 23% of the total DRAM wafer output, representing just 10% to 15% of shipped bits.
Why does it eat so much wafer capacity? Because of its vertical stacking, HBM bit requires about 3 times the wafer capacity of standard DDR5. Yields are much lower, and the physical complexity is incredibly high.
This translates into a massive price premium of 5 to 10 times per bit over conventional DRAM. Typical list prices reflect this. HBM3 cost roughly $200, jumping to $300 for HBM3E, while HBM4 is scaling toward $500 per stack. Overall, prices have risen 20% to 40% year over year.
And profitability is stunning. While commodity DRAM operates on modest margins of 20% to 35%, HBM operating margins are in the extraordinary 60% to 70% range, driven by demand that grew over 130% in 2025 and is projected to grow another 70% year over year in 2026. HBM has become the single high-margin growth engine of the DRAM industry.
So, who controls this incredibly lucrative bottleneck? If you look at the global landscape, there is no open marketplace. Instead, we have a tight, 3-maker oligopoly. 3 giant semiconductor companies control over 95% of all DRAM production and virtually 100% of HBM output.
First is SK Hynix. Industry analysts widely recognize them as the pioneer and current market leader in HBM, holding an estimated 50% to 62% of the global HBM market share. As an early partner to NVIDIA, they qualified chips first, becoming the primary HBM supplier for the Blackwell and upcoming Rubin platforms. Operating at 60% to 70% margins, they are already qualifying and ramping up next-generation HBM4 chips.
Second is Samsung, holding a major market share of roughly 25% to 40%. They have unparalleled manufacturing scale, but faced qualification delays on the premium HBM3E tier with NVIDIA. Still, Samsung began mass production of HBM4 around the first quarter of 2026, aiming to use their scale to aggressively claw back market share.
Third is Micron, holding an HBM market share between 5% and 22%, with many estimates pointing to around 20% for the year 2026. Micron achieved a strategic coup by qualifying HBM3E with NVIDIA and AMD in 2024, becoming a credible second source. Offering a US-based fabrication option, they provide an attractive hedge for supply chain security.
Remarkably, their combined HBM capacity for 2026 is completely sold out, with multi-year supply contracts stretching well into 2027 and 2028.
And according to TrendForce, the ultimate bottleneck isn't raw wafers. The true physical constraint is advanced packaging. To build HBM, you have to stack 12 or 16 DRAM dies, grind them down to a hair's width, connect them with thousands of microscopic through-silicon vias, and bond them. Advanced packaging is where the battle is won.
When examining tech bottlenecks, a classic question we must ask is, won't this eventually get commoditized? Skeptics argue that once everyone figures out how to stack memory, the yields will rise, supply will flood the market, and HBM will turn back into a cheap, low-margin commodity.
But this is where our bottleneck lens asks, does the next-generation architecture enhance or replace the bottleneck? If the roadmap makes an input simpler or easier to replace, the bottleneck is fragile. If the next architecture makes it more complex, the moat deepens.
With the transition to HBM4, the consensus is that the moat gets deeper. In HBM3, the interface was 1,024 bits wide. In HBM4, it widens to 2,048 bits, allowing up to 64 gigabytes per stack and roughly doubling the total bandwidth.
The real architectural shift is at the bottom of the stack, the base die. In older generations, it was a passive silicon interposer, a static piece of silicon manufactured by the memory makers. In HBM4, the base die becomes an active, high-performance logic chip.
The base die will now handle complex routing, ECC, memory controllers, and SerDes. As an active logic chip, it cannot be made on memory fabrication lines. It must be built on advanced logic nodes, like TSMC's 5nm or 4nm processes.
Thus, the memory maker cannot work in isolation. The active base die must be co-designed with the compute vendor, like NVIDIA, and fabricated by TSMC. This memory is no longer a standard part. It is custom, partner-locked, with massive switching costs. TSMC enters the value chain, combining its foundry with advanced packaging like CoWoS and hybrid bonding. The technology migration enhances the bottleneck rather than commoditizing it.
This shift drives a fundamental reframe. Historically, memory was the ultimate commodity-cyclical industry with brutal, value-destroying boom-bust cycles. You bought stocks when makers were losing money, sold at peak profits, and braced for the crash.
But HBM's customization, co-design requirements, long contracts, and rapid biennial cadence shift memory toward a growth-cyclical profile.
Under this framework, the industry still cycles, but the floor is raised. Up cycles bring extraordinary profits, but in down cycles, HBM's contracted nature means makers earn less rather than plunging into deep losses. The downside is cushioned because HBM is a strategic, customized asset, not a commodity.
It represents a major bifurcation of the memory market. DRAM manufacturers are separating their businesses into two distinct lines: high-volume commodity DRAM for PCs and standard servers on one side, and high-margin, customized, contracted HBM lines for AI on the other.
However, we have to maintain our intellectual humility here. While the growth cyclical case is compelling, industry consensus is explicit. Memory can never be fully decyclicalized. The standard commodity price portion of these businesses still exists, and it will still amplify the swings of the overall company earnings. HBM cushions the cycles, but it does not eliminate the fundamental laws of semiconductor capacity.
This brings us to the sharpest open risk in our framework, the memory trap of overbuilding. With operating margins of 60% to 70%, manufacturers have a massive financial incentive to build as many factories as physically possible.
Exactly. The capital expenditure wave we are seeing from 2025 through 2027 is absolutely historic. SK Hynix, Samsung, and Micron are pouring tens of billions of dollars into expanding their cleanrooms, purchasing advanced lithography equipment, and scaling up advanced packaging lines.
The risk is that if AI demand from hyperscalers plateaus, or if their urgent, just-in-case inventory building normalizes, the industry could face oversupply by 2027. We have seen this before. Double ordering by worried customers can make demand look twice as large as it is, leading to a sudden glut once those orders are filled.
Another wild card is China's CXMT, targeting over 300,000 wafer starts per month by 2027. They focus on commodity DRAM that is 1 to 2 generations behind and face export controls on HBM. But by flooding commodity DRAM, they could compress commodity revenues of global makers, shortening the broader cycle.
This is why industry consensus suggests a balanced approach. While the structural, long-term demand for HBM remains incredibly strong, investors and industry watchers must watch the 2027 earnings seasons with extreme vigilance. The bottleneck is real today, but fabs can ramp and capacity eventually catches up. We must be highly cautious about the pure, uncontracted commodity price slice of these businesses.
Up to this point, we've talked about HBM as a high-tech battle taking place inside remote, air-conditioned data centers. But bottlenecks have a funny way of spilling over into the real world. This isn't just a corporate story. It is quietly impacting the cost of the technology you use every single day.
It is resource crowding. Because each HBM bit requires 3 times the wafer capacity of standard DDR5 and carries massive margins, makers are reallocating raw wafers away from consumer products. AI could absorb up to 70% of high-end DRAM by 2026.
Starving the consumer market of wafers makes standard prices skyrocket. In early 2026 contract pricing, conventional DRAM spiked 55% to 60% QoQ. PC DRAM surged 105% to 110% QoQ, and server DRAM rose 88% to 93% QoQ. Legacy DDR4 even traded above DDR5 due to absolute scarcity.
The exact same dynamic is playing out in NAND flash memory, which is used for permanent data storage. Raw NAND wafer prices spiked around 250% year over year. Consumer NAND contract prices jumped 33% to 38% in the first quarter of 2026 alone, with industry analysts forecasting an additional 70% to 75% increase for the second quarter.
In real dollars, a standard 1 terabyte SSD that cost about $45 in 2025 has doubled to around $90 in 2026. High component price spikes are depressing the consumer electronics market, with smartphone shipments projected down 13% and PCs down 11% in 2026. Relief is unlikely before late 2027.
Now, let's run these physical and economic facts through our formal 3-question bottleneck screen to see where HBM sits on our duration ladder.
Question number 1. Is it a real bottleneck today? The answer is an absolute, unqualified yes. HBM capacity is fully sold out, controlled by a highly disciplined triopoly, commanding massive price premiums, and operating at extraordinary 60% to 70% margins.
Question 2. Does the next-generation architecture enhance or replace the bottleneck? It enhances it. HBM4-based dies become active logic chips co-designed with compute vendors and built on advanced TSMC nodes, making memory application-specific and partner-locked. The moat gets wider.
Question 3. Can customers fund it? For now, yes, backed by the massive CapEx budgets of cloud giants. But as we showed in Episode 1, this is ultimately gated by AI software monetization. If that fails to scale, those capital budgets will contract.
Where does HBM sit on our duration ladder? We place it in the medium fragility tier. Fabs can eventually be built, so capacity can ramp up. This is why HBM carries a distinct 2027 peak timing risk that power and materials do not.
To wrap up, high bandwidth memory is the textbook physical bottleneck today. It is the silent partner to the GPU, capturing an extraordinary share of industry profits and integrating with advanced foundries like TSMC.
But it demands caution. While the growth story is powerful, the memory cycle still hovers, with a major question mark around 2027 as massive new capacity comes online. In the AI gold rush, we must watch the shovel makers closely.
In Episode 3, we pivot from silicon to the ultimate macroeconomic limit of the AI revolution: power. We'll explore the electrical grids, transmission lines, and energy infrastructure required to keep these AI factories running.
It is going to be a massive, high-voltage conversation. Thank you so much for joining us today on Follow the AI Money, here on The Working Thesis.
We'll see you in the next episode.
Okay, that's our episode. The honest goal here is simple. Hold a few ideas about the world and keep checking whether they're still true.
Together, out loud, a little at a time. If you spot where we've got it wrong, please tell us. That's how this gets better. See you next time.